Hello everyone and welcome back. Today's video we're going to be talking about little or no money down financing options when you're purchasing a business and or real estate that comes along with some businesses. This is going to be a two-part video. The first one we're going to go over the different loan types, and then the next video we're going to go over real world examples and how these payments affect cash flow. And so before jumping in, I do want to be clear. I am not an attorney. I am not a CPA. I am not here giving financial advice. I'm rather sharing the experiences that I went through using little or no money down financing options and how things were affected to the good and the bad. So it is, again, just for informational purposes only. So without further ado, let's jump in. There are two primary methods for little or no down payment financing options when you're buying a business, and they are seller financing or financing through the SBA in the form of a loan. The two most common are 7A and 504. We're not going to be talking about the 504 today, as it usually is more for capital equipment. It may be for more than just capital equipment. That's just how I know it. So we're going to be focusing today a little bit on the 7A. And as always, anything I share here, terms change, different programs change within the SBA. So always do your own research in anything that you're going to be doing with the SBA or any type of financing whatsoever. So with seller financing, this is where the seller acts as the lender to the buyer. Instead of the buyer getting a loan from a bank or another financial institution, the buyer agrees to pay the seller payments over a period of time. So let's say, for argument's sake, we have a $100,000 business that we want to buy. We can go to the bank, we can get a check for $100,000, give that to the seller, and now the seller's paid in full, and you pay the bank every single month. Or we can have the seller act as the bank, where we pay them every single month. This is historically is used when a buyer is unable to secure financing or the seller is motivated to sell. I'm not saying this every single time, but those are usually the two most common times when seller financing is used. So how it works, there's four pieces to seller financing. The first one is your down payment. Buyers typically pay a portion of the business's purchase price upfront in the form of a down payment. They usually range from 5 to 20%, but can be more, can be less. So in this example, $50,000 purchase price, 5% down is $2,500. 20% down is $10,000. And then we have the installment payments. Whatever is left over after the down payment needs to be paid over time with agreed upon terms such as the interest rate, term of the loan, and payment schedule. So in this example, same $50,000, we give 20% down payment. That leaves a balance of $40,000 at 10% interest, paid for the next 5 years in monthly installment payments. Collateral, that is something of value that is used to secure the loan. If you've purchased a home, the home itself is the collateral for the loan, the mortgage that you're getting from the bank, where in this case, the business itself is the collateral for the loan. And then you have negotiation. The seller owns his business. The seller's not bound by any rules that you can negotiate anything and everything: down payment amount, interest rate, terms. You could. What happens if the buyer defaults on the loan? Everything is negotiable within seller financing. Now, here are some pros and cons. Pros to the buyer: easier to obtain seller financing than traditional financing, especially if the buyer has trouble getting a bank loan. Maybe the credit's not up to par. Maybe they don't have seasoned a nice stack of cash sitting in the bank to be used as a down payment. All those things can make it hard to qualify for a loan. Seller financing, another approach to the buyer, can be more flexible in terms of repayment schedule and interest rate. Remember, everything is negotiable. When it comes to pros for the seller may be able to get a higher price for the business because they're offering seller financing. That's a little extra value, a little extra piece there, so they can charge a little bit more. If the business has strong cash flow, they can generate income from the interest payments. Anytime you're charging interest on something, someone is making money. So in this case, seller's charging an interest, he or she is making money off of those monthly payments. Cons to the seller, the biggest one's got to be risk of non-payment should the buyer default. What's worse is if the buyer decides to run the business into the ground, they find out that they are not meant to be a business owner, that could take a valuable business down to nothing and they stop making payments. So seller obviously is on the hook for those things. Seller also may need to wait longer. I shouldn't say may. The seller will be waiting longer to receive full payment, right? Because you're paying them over time rather than giving them one lump sum. Now, I put this in red here. There may be some tax advantages to installment payments. I know one is you're deferring your tax into the later years rather than pay tax on the amount that was realized gain at one time. They spread it out over years. So I don't know how much of an advantage that is, but to some it may be. Now, when it comes to the SBA 7A loan, these loans are offered by lenders like banks, TD Bank, Bank of America, Wells Fargo, all the regular banks or credit unions, but they're partially guaranteed by the SBA. And the SBA is a Small Business Administration. These loans are designed to help small businesses that may not otherwise qualify for a conventional loan. Very popular when someone is purchasing a business. They usually have a lower down payment, usually about 5 to 10%. 10% seems to be the average, and have longer repayment terms and more favorable interest rate compared to traditional loans. I think the standard longer repayment term is 10 years and then 25 years with real estate. Oh, in fact, yes, it says here. So purpose can be used for business acquisitions, working capital, refinancing debt, or purchasing equipment. They lend up to $5 million. That's always subject to change. Down payments, typically around 10 to 20%, as I mentioned. And repayment, typically 10 years for working capital, 25 years for real estate. The interest rate can be a variable rate, but is generally lower than traditional loans. The average is about 8.75% to 10% seems to be what I see. The pros and cons of an SBA 7A loan. Pros for the buyer: lower down payment requirements than traditional loan, longer repayment terms, fixed or lower interest rates. Con for the buyer: the approval process can take longer and require more documentation than a traditional loan or through seller financing. SBA loans can be difficult to qualify for as they require a good credit score, strong financial history, and a solid business plan. And lenders may require personal guarantee, which means the buyer's personal assets could be at risk if the business fails. Most likely, you're going to be asked to put up some personal assets. That could be equity in a home. It could be cash down. It could be cars. It could be all sorts of assets that are owned outright that you can use as collateral. Pro for the seller: SBA loans make the business more accessible to potential buyers, which can make it easier to sell. I know that when I was in the market to buy a business, I was looking for those that were SBA qualified or pre-qualified. The buyers more likely to be able to afford the business, as SBA loans are easier to secure than traditional loans. And a continuation here, another con for the seller is a lot of work to satisfy the SBA. In most cases, it's seller's going to be jumping through some hoops, as is the buyer. Not all businesses will qualify for an SBA loan. I ran into that a few times. There would be a business that I would inquire with the broker. I'd say, hey, I'd like to get an SBA loan on this or some type of financing. And he'll just say that it's not going to qualify. So they already know that. Now, on a final note, SBAs can be used in combination with seller financing. So, for example, the buyer has no cash at all. He wants to buy a business for $200,000. The seller can finance 10%, which would be the down payment required. And the SBA will then finance the remaining balance. So you have your 80 plus 20 equals 200. So everybody is square. Couple words of caution here is the buyers will now have two payments to make, right? If the seller's holding a note for 20 grand, they're going to want their 20 grand and the SBA is going to want their 180,000. So these two payments could be a lot to bear for a long period of time. And there's something called a standby period. And I don't know if this is every time the SBA grants a loan or only in certain cases where cash flow may be questionable. But when a seller holds a note, the SBA may require that seller to defer those payments for a period of time, which is usually about 2 years. Keep in mind that interest is accruing, so the seller's not losing anything, but they may not get any payments for that period of time. And the SBA loans will be in first position. So if the business fails and and you sell your assets, the SBA will be paid first automatically. If anything is above the money that they borrowed, in this case, anything is above 180,000, will start going to the seller. Should you not be able to cover the seller, you are still responsible. And if you sell your assets and only come up with $100,000, you still are required to pay the remaining $80,000 that was lent to you. So buyer is still responsible no matter what. So that is a short and sweet overview on SBA loans and seller financing. I'm going to generate another video in the next day or two that shows the different payments on seller financing, SBA financing, and how they affect your cash flow. So stay tuned, like, subscribe, and I look forward to talking to you soon. Thanks, guys. See you now. Hello, everyone.